Lesson 1. Trading styles. Systematic vs discretionary trading. Most new traders lose money for one simple reason. They picked the wrong trading style before they even placed their first trade. Two approaches for trading we will look into this series: systematic and discretionary. And if you get this wrong, nothing else you learn will matter. I'm Stefanos from MT5 Gold, and let me show you which one you should start as a beginner and why. A systematic trader operates within a rulebook. It has a set of rules and follows them objectively. Everything is defined up front: your entry, your exit, your risk. The market gives you a signal and you follow it. No second guessing, no opinions, just rules and data. Zero emotion. Think of it like surfing. If the conditions match and a wave based on your skills comes, then you ride it. If not, then you sit out and wait for another one or for another day. Discretionary trading. This is what everyone dreams of when they enter trading that they will do. But no, this needs years of experience. And discretionary trader does the opposite than a systematic trader. They make decisions in real time based on judgment and experience, and they are rid of the market. On paper, that sounds powerful, it sounds cool, but here is the problem. Most people who think they are trading discretionary are actually just trading on emotion. There is a huge difference between experience-driven judgment and a feeling-driven guessing. So, if you are a new trader, go with systematic trading. Discretionary trading comes after of years and years of experience in the market. Maybe 5, maybe 10, but certainly not in the first 2-3 years. Now, let's see an example of a systematic trading. Let's say your rule is buy when RSI drops to 30 and a market structure break. So after backtest, many backtests, maybe 100, 200, 300 backtests, you take your system live. You set an alert and wait for a trigger, and then you enter a trade. You don't go to social media on X or any other platforms to hear all those gurus. You trust your system, the one you build. You trust yourselves, the skills that you learn, and you apply them in real market with a risk and money you can afford. So my rule is always start with $1. If you can't have profit in the long run with your system with $1, then why would you have with a risk of $500? So first test it with $1 for a couple of trades, and if you understand it, then scale up slowly to the 1 or 2% of the portfolio you have for trading, so you can handle the emotion, you can handle the feeling, and you are sure that you are not trading with emotion, but by the way, if you are learning something from this video, please subscribe. This is a full trading course and every lesson builds on the last. Now, let me give you the 5 reasons why systematic is the only way you should begin. First, it removes emotion. When you trade, it's based on a rule. You are not panicking when it goes against you. You enter because your system said to. You exit because your system says to. Your ego never has to show up. 2. Clear risk management. Your system tells you where to enter, and it also tells you exactly where you are wrong. Stop loss is defined before you even place a trade. No moving stops, no hoping, no halting losers. That's why the first thing we mark is our stop loss. The first thing we should care how much we will lose and at which point of the market if we are wrong. 3. It's the only way to actually learn. Here is what most new traders do. They see someone posting gains, they copy the trade, maybe win once, lose 3 times, and have no idea why. That's not learning, that's gambling. Systematic trading forces you to track results and review data, real numbers, your win rate, average win, average loss, the expected value. That's how you improve. That's how you learn. By keeping a journal, backtesting, and track the market day by day. Trading is like a job. It takes time from your life. It's not something easy, but not hard. It needs consistency. You need to do the right steps for a long amount of time, and good habits compound in a great result. 4. Backtesting. You can test your strategy on years of historical data before risking a single dollar. You get real numbers, but you can't backtest a gut feeling. You can't improve what you can't measure. That's why systematic trading is what beginner traders should go with. And you can backtest for free, and you can take your system live with just $1 of risk. No reason to risk more than that until you are sure that your system is profitable and you follow your rules objectively. Then you scale up slowly. 5. Shorter learning curve. The fastest way to learn anything is to collect data, analyze it, and adjust it. Systematic trading is exactly that, applied to the markets. Now, let me show you why discretionary trading is dangerous for beginners. A 2015 study found that roughly 50% of discretionary accounts underperformed the market. Only about 20% generated above market returns, and those aren't beginners, those are experienced traders. Here is a pattern we all observe. We know it, but we don't act. Someone sees a tweet, goes long with no system, no stop loss, and trade goes against them. They move their stop loss, average down, and eventually their account blows up. This happened to all of us and happened many times until we took action and learned the proper way of trading. So we don't risk a lot of money and we learn the proper way. I had a situation once when I saw Bitcoin pumping and went in based on a feeling. No plan, no stop loss. Within hours, I was deep in red, holding and hoping. That's what discretionary looks like when you haven't earned it. You enter on emotion and you have nothing telling you where you went wrong. So you just hold and pray. And the worst part, you can't fix what you can't measure. If your entries are based on it felt right, there is nothing to go back and review, nothing to improve. Now, I'm not saying discretionary does not work. It absolutely can, but it's earned with years of experience and compounding healthy and right habits. You build your systematic foundation first, you test it, you trade it, and you track every single trade. You review your data weekly and journaling. Then, after serious time in the market, after you truly understand the structure, probability, and yourself as a trader, then you layer in some discretionary judgment on top of your system. The best traders use both, but the systematic comes first, always. Me, myself, I'm not a discretionary trader. I tried it many times and I blow up my account. So I went back and reviewed and found the correct way, the systematic trading approach. That's why this series of lessons will be about systematic trading and the right approach for a beginner. Now, to summarize this lesson, systematic means rules, data, consistency, and clear risk management. That's your starting point. no exceptions. Discretionary means judgment, intuition, and flexibility. But you need years of experience with systematic trading to earn it. So start with a system, build clear rules, test them, track everything. That's the path. And that's exactly what we are building on this channel, lesson by lesson. If you liked it so far, please subscribe so you get notified for lesson 2. Have a great day, and risk management comes first.